Hi, I'm Shae Smith, Weekend Editor of Money Morning and Tech Insider. Over the past 2 videos, I've explained some very basic concepts of technical analysis, including the different chart types, trend lines, and support and resistance. Today I'll take it up a level and show you some useful indicators when it comes to using charts, including one method based on number patterns developed by a 13th century mathematician. But let's start with the most basic but still useful indicator, a moving average. As the name implies, a moving average is the average price of a stock over a set period of time displayed on a chart. You can set a moving average to any time period you like, but the most common ones are a 10-day moving average, a 35-day moving average, a 50-day moving average, and a 200-day moving average. The shorter time periods are used when you're looking to determine a short-term trend. The longer periods are useful when you want to look at a longer trend. As a basic guide, when you see the price data sitting above the moving average line, it's in an upward trend. When the price data is below the moving average, it's a downward trend. However, by using 2 moving averages of different time periods, you have a greater chance of determining a trend reversal. For example, if you were looking for short-term opportunities, you may want to use a 15-day moving average and a 30-day moving average. When one moving average crosses through the other, that's a signal the trend has changed direction. So here, inside the circled area, the black line, which is the 15-day moving average, has moved up through the purple line, the 30-day moving average. And this is the signal of the start of a new uptrend. For longer periods, you may want to use a 50-day moving average and a 200-day moving average to pick a longer trend. As with the shorter periods, when one of the longer time frames crosses through the other, it suggests that the trend has changed direction for the long term. Moving on from that is the Moving Average Convergence Divergence, commonly called the MACD. Beginners and advanced traders alike use this method. Basically, the MACD is 2 exponential moving averages measuring the momentum of a share. Like a standard moving average, you'll see 2 lines moving with the price data. One is a shorter term moving average and the other is a longer term moving average. However, underneath the chart, you'll see another bar graph called a histogram. In this graph is a centre line with 2 smoothed out moving averages. Similar to those on the price chart, the idea is that the short-term moving average is measured against the long-term moving average, which signals the current momentum of the security. When a MACD is trending up, the shorter-term moving average is above the long-term line on the histogram. It's the opposite for a downtrend. When the longer-term moving average is above the shorter-term line, it's telling you the stock has a downward momentum. Most importantly, when a MACD crosses through the centre line, it signals a crossing in the moving averages as well. This generally tells an analyst that the trend is changing direction. The most common time frame for a MACD is 12 days and 26 days, but volatile stocks may require a short time frame, and less volatile securities could use longer periods. Now we'll look at the Relative Strength Index, or RSI. The RSI is used to determine overbought or oversold conditions in a security. Basically, the indicator is plotted on a range between 0 and 100 and is displayed below the price chart. Whenever the indicator is about 70, it signals that the stock may be expensive, and when it drops below 30, it suggests that the share is cheap. This is a useful tool to detect a trend reversal. The standard time period for an RSI is 14 trading days, but more advanced traders will often change this to suit their needs. It's important to remember the shorter time period for an RSI, the more volatile the reading. Now let's move on to one of the most popular indicators used today. It's a key set of numbers identified more than 700 years ago. I'm referring to a Fibonacci retracement. It's not that the numbers are important when it comes to using a Fibonacci, but the relationship between the numbers that counts. Put simply, a Fibonacci retracement shows that stocks tend to always come back to certain points. In Fibonacci, these certain points are called ratios, and it's these ratios that can identify when a security is likely to reverse its current trend. Firstly, the Fibonacci number sequence starts at 0, and then the next number is simply the sum of the 2 preceding numbers. For instance, 0, 1, 1, 2, 3, 5, 8, 13, 21, 34, 55, and so on. The unique part of Fibonacci numbers is that each number is approximately 1.618 times greater than the number preceding it. The Fibonacci ratios are 23.6%, 38.2%, 50%, 61.8%, and 100%. Basically, these ratios form critical points that generally determine where a security will reverse direction. The direction of the prior trend is likely to continue once the asset price has retraced to one of the ratios. Well, that's it for this lesson. In the next video, I'll explain the concept of if-done orders and how to use support and resistance lines to identify buying and selling points. I'll see you then.